Started then. All right.
Yeah.
So, hi everyone. Welcome and thanks so much for joining us for the next session in the Personal Finance and Career Success in Anesthesia series. We appreciate everybody who's here tonight to learn about disability insurance, which is definitely one of the most important things, especially for physicians in training, to get done before they move out into practice, and something that's critical for practicing physicians to secure as well. So we've brought a real expert tonight, Andy Borgia of DI for MDs. He's here with his associate, DK Unger. They are both independent insurance agents, which means they are not indebted to any single insurance company, so they can shop out to find you the best rate out there. I have personally used Andy for both myself and my wife's life insurance policy, as well as my disability insurance policy. So that is my conflict of interest statement. One of the reasons I chose to go with Andy is because he and his company, DI4MDs, are is the firm that you are able to get the UCSD guaranteed standard issue disability policy through. So that's something we'll discuss more tonight. But I'm sure, as you'll see, it's a unique opportunity for residents and fellows at UCSD, and it's definitely something you should be considering. So Andy is not getting paid to give this talk, but obviously we'll be giving his contact information to you should you choose to want to purchase any insurance through them. So with that, I will pass it off to Andy. Thank you so much for being here. We really appreciate your time.
All right, thanks, Dan. Thanks, Shane. As Shane was mentioning, I'm Andy Borgia, and I have DK Unger, my associate here, and we're the principals of DI for MDs, which is kind of a boutique insurance agency. We specialize in disability and life insurance for physicians and businesses. The insurance industry is similar to the financial industry in that everybody specializes. So some people specialize in disability, some people specialize in life insurance, some people specialize in auto insurance, et cetera, et cetera. So one thing that you want to do when you're looking in the financial industry is, just like in medicine, if you kind of take the same approach when you have an issue that you want, whether it be insurance, a will or trust, investments or whatever, go to someone who specializes in it, that does it 24/7. Try to stay away from the generalists that you kind of do a little bit of everything. So we're going to concentrate on disability insurance tonight, and we'll get into some life insurance a little bit. This is our resident fellow disability insurance guide. And how this talk is going to kind of proceed is we're going to give you all the information you're going to need to understand and dissect disability insurance policies, what to look for, what not to look for in your policies. And then we're going to get into some specifics regarding definitions of disability, which is pretty much the key of how you're going to get paid in the event of a disability. And then we'll examine all the different disability policies that are available to you as a resident or fellow at UCSD. And then finally, we're going to zero in on the one unique factor and benefit that you have as being a resident or fellow at UCSD, which is the pre-approved discounted disability plan that'll cover you in your specialty. So I'm going to proceed with this guide. The first part of the guide just kind of tells you this, what everybody already knows, is that every physician should have disability insurance. Second part here, I'm going to scroll down, and these are the 4 key components or provisions of any disability insurance policy. The first one is the definition of total disability. So you want your policy to have words like that are annotated in green here, where it says inability to practice the material and substantial duties of your occupation. If you have limited your practice to a specialized area of medicine, you want to be covered in your specialty. You want to avoid contracts, whether they be disability or anything, that says something like completely, any and every, all, any occupation, gainful occupation, training, education, experience. When you see those type of words, it really inhibits your ability to collect at claim time. Second key component of a disability policy is the partial residual disability benefit portion. And all disabilities at some point whether they be an accident where they're pretty much they're total first, and then as you recover, become partial, or a sickness, which a lot of times will you'll experience a slowing down, et cetera, and you won't know what's wrong, and then all of a sudden you'll develop a sickness, and then you become totally disabled. So what you want though is in a partial policy or in a disability policy, you want to make sure that your policy is going to cover you for total disability or partial disability. Partial disability is if you can, ideally, if you can go back in your specialty on a part-time basis, and if you earn less than 20%, you're considered totally disabled. If you're able to earn over 80%, you're considered totally well. So the partial disability is for kind of for that quarter in between the two. So if you're able to come back half-time and you work 50% and earn 50% of your income, then you receive 50% of your benefit. So partial is key in any policy. And ideally, you do not want to have to be totally disabled first before you collect partial disability benefits. Most of the good individual disability plans, you can collect on partial disability if you're even never totally disabled. Third is a recovery benefit. And this benefit doesn't probably impact you that much right now during your training, but when you come out of training and you're in practice, then it will have an impact. How the recovery benefit works is that when you're in practice and you do a case that day, well, you don't get paid that day. It may be a few months down the line by the time everything works through the system and before you actually receive revenue from something you did today. So how that impacts a disability is that if you've been out for a year or two and you come back to work and you're ready to, and you go back to work so you're no longer medically disabled, well, what happens is that you go back to work, the disability policy will stop paying you because you're no longer disabled. You've started work, you're doing cases or you're doing shifts or whatever, but it's going to take a few months before you start receiving money from that. So there's kind of a void there that occurs where you're not going to be receiving anything even though you're working. So what most of the good insurance company individual policies have is they have a recovery benefit to kind of compensate you during that time when you're really not medically disabled, but you're kind of financially disabled. So it's key to have a recovery benefit in there. And then finally, the presumptive disability benefit. And that's kind of like it says, they presume you to be disabled. And that's kind of what everybody thinks. That's the worst type of disability, et cetera. It requires a loss of 2 or more limbs, or the use of 2 or more limbs, usually the loss of sight, speech, hearing, anything like that. A lot of specialties, you won't be able to work if any of those things happens, like anesthesia. You're not going to be able to practice too much, maybe unless you're in a wheelchair or something like that. But so presumptive disability is going to pay you if any of that happens to you, whether you can practice or not. So it's real key to have all those 4 components covered in a disability plan. And hopefully this is all academic, but the statistics show that disability is the most likely event to occur in a physician's career over anything else. Obviously everybody dies, but not always during their working years. So disability is critical, particularly for someone who's highly trained as you all are out there. So the next page, we're going to go into how the insurance companies determine how much they charge you. And so the premiums are based on what your monthly benefit is. And disability plans have, you purchase them in monthly benefit, which is kind of related to your income. So you can get like $1,000, $2,000, $3,000, up to $20,000, $25,000, $30,000 a month of coverage if your income's high enough. The second factor is they determine how much they're going to charge you is based on your age, your gender, your what specialty you are, where you live, what your health is, what type of policy you have, and any available discounts. So the UCSD, you're fortunate for all of you out there, particularly the females, is the UCSD, we were able to negotiate a gender neutral discounted rate. And so that means males and females pay the same. So if there's a pretty big discount for females, there's a big discount for males. But either way, it's a discount and it's gender neutral. Also, there's no health issue. And statistically, almost 2/3 of the policies that are applied for are not issued as applied for. They're either issued with an exclusion, a rating, a reduced benefit period, lower monthly benefits, et cetera, because of usually health or avocations. So with the UCSD, we've kind of mitigated all that, so that's not going to be an issue. Specialties is an issue, and there's nothing you can do about that. You've already chosen your specialties, pretty much. But insurance companies, they rate the specialties based on claims experience, and the highest incidence of claims in the insurance industry is anesthesiologists. And so if you're not a UCSD, a female anesthesiologist is the highest risk according to the insurance companies. Then you have other invasive specialties, which are a little bit more, and ironically, pain management is a better risk class than anesthesia. Then you have surgery, emergency medicine, reproductive medicine, etc. The invasive specialties carry a higher risk than, say, psychiatry, internal medicine, cardiology, dermatology, ophthalmology, etc. But that's something that we will negotiate with you or talk to you out on that on an individual basis. But it gives you kind of an idea of, the riskier or the higher skills that you need to practice your specialty physically, the higher the risk is going to be for the insurance company. On the bottom part these are the basic provisions in a disability policy. The first is the elimination period, and that's the period of time before benefits begin, and that's similar to a deductible in a medical insurance policy. Just like I said earlier, it takes a while for the payment schedule or the payments to wind their way through the system. So usually if you're disabled right away, well, you still are receiving income. If you're practicing, you're still going to receive income for 2, 3, 4 months. So typically disability plans have a 90-day waiting period, and that's a period of time before benefits are going to begin on that. And you could have a longer waiting period if you want, but the premium does not change appreciably for the longer waiting periods on that. The next is the benefit period, and that's how long benefits are going to be paid in the event of a disability. So ideally you want that benefit period to be covered, your own specialty to be covered for the entire benefit period. So you can have a benefit period between 2 years and to age 70. Typically it's age 65 or 67 is usually the typical benefit period. And what that means is if you get disabled, say as in anesthesia, you can't practice anesthesia, but you can do something else. You can teach, you can do insurance exams, you can do internal medicine or whatever. Well, if you had a specialty specific policy, your benefit would be paid to age 67. If you didn't, then your benefits may be paid to age 67, but it might only be a partial disability benefit. Or you may not have any benefits at all, because if you could do anything, some plans won't even pay you on that. And so the benefit period, ideally, is what you want, is something that's going to be, you're covered for the entire benefit period in your specialty. Optional provisions are the next. The first one is the future purchase option, and that's pretty critical for any resident or fellow. And what that option does is allows you to increase your coverage in the future, regardless of health, as long as your income qualifies. Because you're all probably at a lower income level than you're going to be, and you've put in a lot of time and effort to get to where you are now, and so you want to protect that earning ability. So the future purchase option allows you to increase coverage in the future, no matter if you developed a bad back or whatever. They do not ask you medical questions. So it's a pretty important clause to add on your policy. The next one down is a cost of living option. And that option, it sounds like a good option, and it is a good option for the insurance companies. How that option works is that after you've been disabled for 1 year, then the insurance policy will pay you an increased benefit based on what the consumer price index was for that year you're disabled. Generally, that's usually about 2%. Now, for that increase, what the insurance company does is they charge you about 25% more for the premiums. So you're actually better off increasing your monthly benefit than adding this cost of living adjustment rider. And to give you an example how that works is a $4,000 a month policy with a cost of living rider is about the same price as a $5,000 a month policy without it. And so if you and your twin each bought a policy, one with the cost of living and one without, well, the first year you're going to get $5,000 a month. Second year, your twin's going to get $4,000 a month. Excuse me, the first year your twin's going to get $4,000 a month. Second year, you're still going to get 5,000. Well, now your twins are going to get 4,000 plus maybe 2%, so it'd be 4,080. Then the third year, you'd still get 5,000, and then it'd be maybe 4,160, et cetera, et cetera. So you can see it takes a long, long time before you even equal the premiums or the benefits you've received that you've already paid for with this cost of living adjustment. And then in reality, what happens is when there is a claim, if your claim is going to last a long time, what the insurance companies like to do is they like to purchase your claim. And by that, I mean, they go, okay, we're going to have to pay Andy $5,000 a month for 30 years. Well, when they do that, the insurance company has to set up a reserve, because unlike banks that go bankrupt, et cetera, the insurance companies are pretty well limited in what they can invest in. So they have to set up a reserve to make sure they can pay your claim, which obviously has an impact on their finances. So what they try to do is they say, okay, well, if we have to set up a reserve and basically put it in a box, $1 million, to make sure we can pay Andy his claim, well, maybe Andy will accept $300,000, and that'll free up $700,000 of ours that we can use for other things. And so more often than not, they're going to try and purchase, and it's good for even for the disabled person, because now you're not waiting on the insurance company to, maybe stop paying you or have to fill out forms every few months, et cetera, on that. So that's why the majority of the claims are settled, and why I don't think that mathematically the cost of living rider is a good rider. The last one is that student loan protection rider. And right now, well, there's a lot of talk about student loans in the news, everybody forgiving everything. But the way it is right now is if you have a student loan backed by the government and you're disabled or die, that loan is forgiven. And the student loan riders in disability policies are only paid if you're still liable for the loan. So you're kind of paying for nothing there. So that I wouldn't really recommend adding a student loan protection rider on a policy. Again, you're better off just increasing your monthly benefit if you can.
Can I interrupt for a second,
Sure.
Andy? So that only applies to government loans though, right?
Correct. Yeah, if it's a personal loan and you're still liable for it, then you could get some. But again, it'd be better is for that same money, if instead of getting $4,000 a month, you got maybe $4,500 or something to use, whether it's for a loan or whatever you want on that. But that's a good question on that. The next slide here these are the 3 different types of disability policies that you're going to experience or have access to during your career. The first is individual, and those are the most comprehensive, and that's an agreement between the insurance company and you. The policies are generally non-cancelable and guaranteed renewable, which means that nothing can change in the policy. They can't raise rates, reduce benefits, add exclusions, cancel you. It's not like auto insurance, where if you have a ticket or something like that, or sometimes medical insurance or other insurances, if you have a flood in your house, then they're maybe not going to cover you anymore. Disability insurance, an individual disability policy, no matter how many claims you have, they can't change the policy. So, and they can't change the rates, they can't change anything. So that's the type that you want to have. It has the most robust benefits, and it's kind of like buying as opposed to renting on that. And that should be the foundation of your disability insurance portfolio. The next are the association plans, kind of like the AMA. And we all know that, I know you guys all get numerous mail, emails, etc. from the AMA. So an association policy is somewhat similar to an individual policy in that you have to answer medical questions to qualify, and you pay for it yourself. Now, the difference is that an association policy, they can't pick you out individually, but they can, the insurance company, since it's an arrangement between the insurance company and the association, they can change the policy provisions at a policy anniversary. Or they could say, well, you know what, since anesthesiologists are high risk, we're not going to cover any anesthesiologists, or we're not going to cover certain states like the AMA does. And if you're healthy, well, maybe what'll happen is you'll just, if they stop your policy, and they can't pick on you, they'd have to stop like for the whole state or the whole class. They can't look at you individually. But because of that, and because they can change the policy terminology, they can change the rates, and the rates do change. You can see the schedule on that. They're really designed as supplements to individual plans. And we'll get into the actual definition of like the AMA plan in a few minutes here on that. And the last one is the group policy. And that'd be like, like for instance, UCSD as a group. So any employee of the UC system has access to an employee paid group disability policy. Those policies are similar to the association policies, and that's an arrangement between your employer in this case and the insurance company. But there are no medical questions on that. So if you do have some medical issues and that's the only type of policy you can get, well, then you have to grab it, because something is always better than nothing. But individual policies, the language is restrictive. It doesn't really cover you in your medical specialty. And probably the biggest deterrent for individual or group policies versus individual is group policies are subject to ERISA. And what that means is that in the event of a claim dispute, your legal recourse is somewhat limited. The case is going to be decided by a judge, not a jury. And probably the most important is that there's no punitive damages because of ERISA. So the result of that is the insurance company, if they, and the terminology is usually in those contracts where they can delay claims quite a bit or deny them, is that they don't pay you, and ultimately you succeed in getting them to settle your claim. All they have to pay you is what they would have paid you anyway. So there's not a lot of a deterrent for that. So again, the group plans should just be utilized as supplements to individual policies. And again, if you leave the group, usually the policy will stay with the group. You can't, it's not portable, or if it is portable, it's a severely limited, restricted policy. The last part there is, I guess this is our little disclaimer here, is where to get a policy. There's a number of people like us throughout the world, throughout the United States, throughout San Diego, etc. So we'd like to have you get it through us, but obviously you're free to establish your coverage anywhere you are, anywhere you want on that. And our contact information is at the bottom of that. So now we're going to get into some specifics. And this is the group plan offered to all UC physicians, all UC employees. And so I'm just going to read this off, because you guys are all intelligent enough that once I read it, you'll kind of realize that, hey, maybe this isn't as comprehensive as possible. And I guarantee you, probably over half the people that have the UC plan have never read this definition, unless they have a claim, or they're talking to someone like us. It says, when Liberty, and that's the insurance company, receives proof that a covered person is totally disabled, notice it says totally there, due to injury or sickness, and requires the regular attendance of a physician, Liberty will pay the covered person a monthly benefit after the end of the waiting period. And the waiting period for the long term is 880 days. It says the benefit will be paid for the period of total disability if the covered person gives Liberty proof of continued total disability, and 2, regular attendance of a physician. So totally disabled with respect to long-term disability means that during the elimination period and the next 24 months of total disability, the covered person, as a result of injury or sickness, and is unable to perform with reasonable continuity the substantial and material acts necessary to pursue his own occupation in the usual and customary way. And thereafter, the covered person is unable to engage with reasonable continuity in any occupation in which he could reasonably be expected to perform satisfactorily in light of his age, education, training, experience, station in life, and physical and mental capacity. So basically what you're looking at there is, at most, you're going to get 2 years worth of benefits on that. Now they also go on, there's a partial disability. And the partial disability kind of takes away from the total disability definition, because partial disability says, or partially disabled, means it has a result of injury or sickness. The covered person is 1, able to perform 1 or more, but not all of the material and substantial duties of his own occupation, of his own or any other occupation, or on any active employment or a part-time basis, or 2, able to perform all the material and substantial duties of his own or any occupation on a part-time basis. Now you can see that's even a little hard to read. And so what it's basically saying is that total disability is not going to really come into play, because if you could do another job, another specialty or whatever, you're not going to be considered totally disabled. You're going to be considered partially disabled if you can do one or more duties of another specialty. So, or another job, even can go even so far to say if you're a staff physician and you can do some administrative duties, well, you're not going to get paid, because you're not totally disabled. You'll just get partial disability. So what'll happen is you'll just get a partial base, and it'll be reduced based on what you're able to earn in administratively, or et cetera. If you're not doing administrative work before you're disabled on that. So that gives you an idea, and that's pretty typical wording for a group disability policy. And so the lesson there is don't rely on your disability benefits from wherever organization you may be employed with, because they're all pretty much going to be worded like this on that. And then the second part here gives you, this is the AMA definition of disability. And it starts out pretty good. It says, if you're unable to perform the duties of your own medical specialty, benefits, and there's that word again, can be payable at age 65. And so then they go on to say, similar to the UCSD plan, it says they kind of give it to you in one clause and they take it away in the other clause. It says benefits for part-time work. This plan allows you to make a gradual transition back to full-time employment following a covered total disability. So that means you have to be totally disabled first before you even get partial disability benefits. So you have some sort of sickness that never totally disables you, and we've had a number of these, like breast cancer. You're 2 weeks on, 2 weeks off. You're never totally disabled, maybe. So the AMA might not even pay you for that. And then it says you can receive a residual benefit if you return to work on a part-time basis in your own specialty or any other specialty or occupation, if your monthly income is reduced by at least 20% and you first receive benefits for total disability. So again, they're pretty much saying that if you're not totally disabled first, we can get out of paying you. And based on this terminology, they legally could. Whether they do or not is up to them. If it's a small claim, they might not. But based on the terminology, they could. And when insurance companies, they have attorneys that draw these policies up. And when they draw them up, they do that and they put the words in either for your benefit or for the company's benefit. Because they know exactly what the liability is for each clause or each terminology they put inside there. Next slide here gives you an idea of the importance of getting a guaranteed approved disability policy. And this is for 2020, and this is from Standard Insurance, which is pretty much the largest disability insurance carrier in the United States for individual coverage. And it says for every application, when all their applications, only 41% were approved as applied for, and 59% were approved with modifications. And the modifications would be something as simple as if you've had a C-section before that, they're going to put an exclusion on normal pregnancy. If you've had a heart problem, you hurt your ankle or whatever, they're not going to be covered. If you happen to be a rock climber, they're not going to cover rock climbing. If you have some other health issues, they may only give you a 5-year benefit instead of an age 67 benefit. So all that combined basically says that 2/3 of the time you're not going to be approved as you applied for on that. And so that's one of the big advantages of the UCSD plan is that if you do it right, you can if you apply to the UCSD plan and you're approved first, well then you're free to shop if you want other companies. But if you apply for a company and you're declined for coverage, pretty much, you're not going to be able to go back to and get a guaranteed approval policy. So it's kind of difficult. And every year, no matter how many people know about it at UCSD, they always have 4 or 5 people that, and it's kind of the fault of our industry because other agents don't know, or they choose not to know that certain health issues are pretty much automatic declines. Like if you're on medication for mental illness or something like that, depression, that's almost an automatic decline or exclusion. that if that happens, you're not going to be covered. And so, go ahead.
Oh, I was just going to say, I wanted to emphasize here because I'm not sure if you had gotten to it yet or you were going to say it, but the standard insurance company, I think, is large enough that they're able to offer this situation where they'll take, kind of larger institutions, a certain number of agents, and allow them to provide this kind of no questions asked disability insurance for trainees to, try to get people early. It's good for them
Correct.
too.
Correct.
But the only way to get what he's describing, this policy where it's no questions asked, is as a trainee. And if it's at UCSD, it's through Andy Borgia and his company, because Standard specifically has chosen them to provide this. So if you do apply anywhere else and you get turned down, that is going to be something you would have to report when you're doing the paperwork with Standard, and that would disqualify you from being able to do this.
Correct.
So if anything, even if you don't want to buy this insurance, you can apply for it, get it set up, and then you can shop around and see if you can get it cheaper somewhere else. But if anybody turns you down there, you're still solid with Standard.
That's the appropriate way to do it. That's the best advice of probably this whole talk, Dan, is because in fact, I just wrote a blog for White Coat Investor regarding that very subject, because every year Standard has about maybe 20 of these programs around the country. And I mean, and we're pretty involved with UCSD. We every year over 100 people sign up. And so it has some visibility, but shockingly enough, there's still probably 4 or 5 people every year that contact us after the fact that have been declined because they applied through elsewhere. And at that point, there's nothing we could do about it. And I think part of that is that, in fact, ironically, we just had a situation where, I mean, you're all familiar with Google, and well, what you can do is you can actually pay what they call pay for clicks. So, like for instance, if someone is searching for disability insurance, as an example, we could bid and say, okay, I'll pay $10 for that when someone searches. Well, another organization was actually paid to be, they bought an ad for DI4MDs.com, so that if someone was looking for us, they put us in there, they put DI4MDs.com in the Google search, and this other company would show up. That was a disability insurance company. And I'm sure people, just like anything, everybody thinks, if you're on the outside, you think, well, all anesthesiologists are the same, all insurance is the same, et cetera. They didn't know. And so that's what happens. And other agents that might not be familiar with it, that's one of the reasons why I wrote the article, was to not only notify the residents, fellows, and physicians, but also to notify other agents that, hey, don't do this. It's not good. And that's a great point, Dan, is you could always, if you do this first, then you're set, and you could always look around if you think you can get a better deal somewhere else. But the other way around is not going to work. So, and you can see the statistics, pointed out. And that's, again, one of the reasons why Standard only picks a couple people for every institution, is because what they don't want is insurance is a numbers game. And so they know, okay, they got 100 people from UCSD. They know out of those 100, there might be 10 people in there that weren't insurable otherwise, but they got 90 good ones. And so they can start spreading that out. But what they don't want is, they don't want Andy Borgia and DK Younger to go, oh, you know what? We're going to have you apply to Standard if you have a health issue. But if not, there's other companies here that will do, because we make more with those companies. Well, that's not going to last very long, because what happens is there's kind of an adverse selection occurs. And the same thing where all of a sudden that risk pool gets smaller and smaller, at some point, all you're going to have is unhealthy people in there. And then they're going to yank the program. And that happened at UCLA. It happened at UC Irvine. It happened at UC San Francisco already, because of that same set where they were just getting not enough people to really make it worth their while on that. And so that's a good point. I think we spent some time on that. Now this right here, go ahead.
Hey,
Sure.
sorry to interrupt you. I just also want to say that's an excellent point. That's exactly what I did. Got standard and then moved to another. But we had a couple questions come in
Sure.
regarding UCSD's group policy. I just wanted to maybe touch on those before we hit into the true own occupation.
You mean the staff policy?
Yeah, the staff policy.
Okay.
So one of the questions was based on the wording. Is it true that the policy will only pay out after 24 months of total disability, or is?
No, it pays for 24 months.
And then after that, it does not. So it's only.
Well, you'd have to qualify if you can't do anything.
Okay. But is there, so is it a different qualification for those first 24 months?
Yeah, so for the first 24 months, it's pretty much going to be your inability to practice your specialty.
Okay.
And then after that, well, they say own occupation. So
yeah,
occupation is different than specialty,
right?
Because occupation is physician, specialties, anesthesiologist. So they could get out of that. But then if you after the 24 months, it says you have to be unable to engage with reasonable continuity in any occupation in which you can reasonably expect it to perform.
And so that any other occupation, the example I was given, which is a good one, is so if you can work as an Uber driver, does that mean you would no longer get paid on this policy?
Yeah, after 24 months.
Okay.
Yeah, I mean that is an occupation.
It is. Okay. Yeah. So, excellent.
Yeah.
Yeah.
Point made. Thank you.
Okay.
The other thing about our policy, I think, you know, for like staff physicians, for attendings, I think it's 180 days before it starts to pay out, right?
Correct.
From whatever the initial injury was. And then there is wording in here about thereafter person covered, and it says reasonably expected to perform in light of age, education, training, experience, etc. But yeah, I mean, it does leave it open for you to do just about anything and not qualify anymore as totally disabled.
Correct. And the other kind of caveat with the UCSD plan is, since it's a UC employees, not a physician plan, is the physicians, as you know, get paid. There's a number of different components. Well, for the disability, only the X income counts. So your benefits are based on X, not Y, Z, all the other components. So that time, that could be a shock sometimes, to where you're thinking, well, I've got 60% of my total income, where it's not really 60%. It's 60% of a portion of your income on that.
And so, for some of us, our X is only about a quarter to a fifth of what we actually make. Correct.
Yeah. It's usually, even most of the time it's maybe only a third sometimes, because it kind of has to be the same for everybody, and that's how your system is set up. So because the physicians are they do clerical work, clinical work, and so you have the ability to increase your income, where the other specialties or other occupations don't have that on that. So I'm going to get to the this is the comparison. So these are pretty much the 5 companies that are kind of the leading providers of disability insurance for physicians. And I know, Shane, we talked about this before. I did not put Northwestern Mutual on here because they really aren't one of the leading providers, and their terminology is such to where it's really not really of a benefit for a physician to have. So the one on the far left is the standard UCSD pre-approved plan. Then you have Principal, Guardian, Mass Mutual, and Emeritus. So all those companies are 100-plus-year-old companies. 4 of them are going to require medical questions or medical approval, script checks, etc., which is the Principal, Guardian, Mass Mutual, and Emeritus. The only one that doesn't is the standard policy. Now that also has a bearing on future claims, because the policies, the standard policy does not really have a pre-existing condition limit on there or any contestable clause, because they don't really ask you anything other than, are you a resident or fellow at UCSD, and if you smoke cigarettes. The others are going to ask medical questions. They're going to see script checks. So if you have a claim within the first 2 years, they're going to look back and see, well, did you disclose everything to us when we established the policy for you? And so it gives them a couple of years to really kind of continue underwriting you if there's a claim, where the standard UCSD plan doesn't have that on that, or that problem. So it has, and also because of the medical questions and application questions, et cetera, with the other 4, there's a possible you can get declined, you can get rated, you can get an exclusion, which is the most likely on that. So you can get a reduced benefit period, increased premiums, and all that. So that's all there, where with the standard UCSD plan, you know exactly what your benefits are going to be and what your premium is going to be going in. So they're all going to cover you in your specialty, except Principal does not mention specialty in their policy. So we have to kind of look at it when we're advising people that, particularly if you're an invasive physician, they do not mention specialty. I don't think their attorneys just left that out when all the other companies put it in their policies. So we kind of recommend that Principal is really not a specialty policy. It's more of an occupation policy, where the other 4 are going to cover you, say, in anesthesia, not just in being a physician. Another clause that's in the Principal plan and the Emeritus plan is that if you are not working at claim time, then you're not covered in your occupation or specialty. It's any occupation. So how that would work in practice is to say you completed your training and you said, hey, you know what, I'm going to take a trip around the world for a year, or I'm going to go volunteer my services, or you're a female and you have a baby and you say, you know what, I'm going to take a year off to be with my baby, and you get disabled during that period of time. You're not going to be covered in your specialty if you have a Principal plan or a Emeritus plan, but with Mass Mutual, Guardian, and Standard, you will be. So that being said, going forward, I'm just going to concentrate on those 3 plans that are going to cover you in your specialty, which is in any circumstance, pretty much. There's the Standard, the Guardian, and the Mass Mutual plan. So if you remember back when we kind of started, there's 4 components of a disability plan. So the first one is the own occupation specialty, which we just went over, and that's how we kind of got down to these 3 companies. Then there's partial disability. That's if you can't work in your specialty, and you could, on a full-time basis, but you could do it on a part-time basis. It doesn't matter if you start out as part-time or finish as part-time. All these 3 companies are going to still pay you if you're only partially disabled first. The Standard, you have to have a 20% loss before that kicks in. The Mass Mutual and the Guardian, it's a 15% loss. So there's a few percentage points there better with Mass Mutual and with Standard and Guardian than there is with Standard. The recovery benefit, the Standard plan will pay, and that's the benefit where you recover from disability, you're no longer medically disabled, and you but you start working. It's going to take a while for you to start receiving income. Well, the Standard plan will pay you up to 6 times your monthly benefit in a lump sum if that occurs, where the Mass Mutual plan and the Guardian plan are just going to pay a percentage. So if you're able to earn 70%, you get 30%. If you're able to earn 30%, you get 70%. But you still have benefits for a recovery benefit. The last major component is a presumptive disability. And that's if you lose your sight, speech, hearing, use of hands, feet, one hand, one foot, something like that. The Standard plan is going to pay for the rest of your life if that occurs. So if you're blinded or whatever, you're going to get paid for the rest of your life, whether you can practice anesthesia or not. The Mass Mutual and the Guardian plan are going to pay as long as the benefit period. If that's 65 or 67, whatever it is, that's how long they're going to pay you. All 3 of the policies have the ability to increase the coverage in the future. Standard doesn't allow you to do it automatically after age 51 with no medicals. Guardian and Mass Mutual goes age 55. So it's a little bit better there, but most people, they've already, by 45, they pretty much increase their coverage to the maximum on that. As far as the exclusions, They all have a 24-month maximum for mental, nervous, and substance abuse on that. And so what that means, if you call up and say, hey, Andy, I'm depressed, I can't work anymore, then you get paid for 2 years, unless it's due to a trauma or Alzheimer's, dementia, something like that, schizophrenia, then you're going to get paid for age 67 on that. If you're outside the United States, and this is kind of interesting, the standard UCSD plan, if you decide that, I'm getting $5,000 a month, and you know what, that doesn't go too far here in San Diego, but if I move down to Costa Rica, I could go down there, relax. $5,000 a month is a lot of money down there. I think I'm going to go live down there. Standard doesn't matter. They're going to still keep paying you. Guardian doesn't pay you while you're outside the United States. And then the Mass Mutual is going to limit you for 24 months on that. So that's just something to be kind of aware of on that. One other thing that the Guardian does not do that the Standard and Mass Mutual do is for acts of war. And this is meaning an act of war that you're like shooting bullets, not if you just happen to be, in a medical tent someplace. Guardian doesn't pay anything while you're training, while you're in the military, auxiliary unit. Like if you get called in because there's some sort of national disaster or something, and that's considered an auxiliary unit of the military, and you got some sort of sickness or injured during that, Guardian won't pay you, where Standard and Mass Mutual are going to still pay you. They'll cover you as long as you're not shooting bullets on that. And then there's other, like if you're committing a felony, you're participating in a riot, intentional self-inflicted injury, those are all not covered. And by the way, Northwestern Mutual is the only policy we've seen that does not cover self-inflicted injury. And pretty much all injuries are self-inflicted for the most part. So that gives them an out of if they want, of not covering you in the event of an injury. They don't have the word intentionally in there. And I think their attorneys they have good enough attorneys to where if they wanted to put intentionally in their contract, it would be in their contract. So that, again, it kind of opens up a little bit. And when DK and I analyze contracts, we look at them, are they putting clauses in to help pay you? Are they putting clauses in not to pay you? Because at claim time, we could be dead and gone, or who knows, we'll be in Costa Rica ourselves, and it's going to be whatever that contract states. And you can't say, well, Andy told me that if I moved to Costa Rica, I'm covered. They're not gonna cover you, or that self-inflicted injury is covered. They go by what's in the policy. That's why I was mentioning earlier with principal, they don't mention specialty. I don't think those are accidents. I think those are kind of intentional in that. So that gives you a good idea of the different types of policies that you're going to have access to on that, whether they be through us or anybody else. The next few pages here are premium pages. And this right here, this first one is for anesthesiology and pain management. And this is during your last year of anesthesia or of training, you're eligible for a $5,000 a month policy with a $10,000 future insurance option. So what we've done here is we've kind of separated out. You can see standard male, female at age 30 for a $5,000 a month policy. Whether you're male or female, you're going to pay $292 a month, and that's going to stay the same forever. If you're pain management, it's going to be $192 a month. If you want the Meritas policy, that doesn't cover you if you say take some time off, et cetera, et cetera. If you're a male, it's $192. If you're a female, it's $315. You can see here, females are quite a bit more than males, and for every company. So, but for anesthesia, probably either the standard plan is comprehensive, and if you're young enough, it's not as big of a premium difference. If you're a female, there's no question you should take advantage of the UCSD standard plan, gender neutral plan. There's no question on that. If you're a male, we'd like to say that the second best choice if you can qualify medically, is for anesthesia is to use the Mass Mutual plan, because that has the closest contractual provisions with standard on that. For all the other specialties, though, it's pretty much not as close as this. Anesthesia standard rates them are riskier than other companies, and since they pretty much have more claims than most of the other companies, you probably see the other companies are going to be pretty similar. The closest one that has probably the largest second group is Guardian, and you can see that Guardian and Standard, their rates are pretty similar. The only difference for males anyway, for females, obviously it's not close, but all these other ones you have to answer medical questions. So what you don't want to do is you don't want to say, I'm going to apply to Mass Mutual. They come back and they give you some sort of exclusion or something, or they decline you. Then you can't come back and say, oh, Andy, I want the standard one after all. You can't do it that way. The best thing is obviously to let us kind of guide you through the process on that. Next page here is just gives you an idea. These are for an invasive physician, like emergency medicine, surgeons, etc. And again, you got the top 3 up there for males and females. And you can see that, the standard plan, no medical questions, and has some superior terminology to the Guardian and the Mass Mutual. It's a better option. For females, again, as I mentioned, there's no choice. There's no really that any female who leaves UCSD without taking advantage of this is going to cost herself thousands of dollars throughout her career. On that. Males, they're going to be saving not quite as much, but there's the medical issue as well. The Meritas policy and the principal policy, again, they're really not going to cover you in many ways. So particularly the principal is not even an own occupation. So you can see for invasive, it's a little bit closer, but there's not a compelling reason to go away from the standard plan. And then for the non-invasive, it's pretty much the same proportions there. Again, females are way more than males. Standard is still right in there, competitive. And so with the contractual provisions that you get with the standard plan, and the fact that you do not have to take medical exam, and also the fact that you don't have to start the plan until you pretty much getting close to completing your training. So you don't have to worry about, well, my health changes or something. That some of the other arguments that are given as well. You start your plan now, because if you have a health issue, you're not going to be able to get coverage later on. We've eliminated that risk. So this gives you, like I say, it gives you a chart of what to look for. Non-invasive would be like terminology. Would be like dermatology, psychiatry, pathology, gastroenterology, etc., and all that, internal medicine. That's all these categories here for that. And then finally, those last ones here, this is, and one thing I have to clarify, and all these, it doesn't mean that at 30 you pay 161, at 35 you pay 219, at 40 you pay 285. If you start out at 161, that's what you pay for the rest of your career. And it basically, you save about 5% every year that you get the policy without waiting. And so that translates out to about 2 years of saved premium. So if anybody has a birthday, say between now, say if you're leaving you're completing your training, and your birthday is between now and say July 1, well, it'd be prudent to start your policy before your birthday. And it has to be on the first of a month with the pre-approved plan. So if your birthday, for instance, is July 7th, if you start the plan July 1, you're going to save, basically 2 years worth of premiums throughout your career. If your birthday's April, well, we should start at April 1, because again, you're going to end up saving premiums. And to give you an idea on how that can impact you, you could look here and say for $5,000 a month, if you're 30, you're going to pay $292. But if you wait till you're 31, you pay $309 a month, and that's every month for your whole career. So that starts adding up, on that. So, and this first chart here, 2P is for anesthesia, and then this next one here is 3P, and that's for invasive. So you can see that it's less, but that same plan, the 30-year-old Now you're paying $191 as opposed to $202. So that's $10 a month every month. So you almost save a month a year for 30 years. You know, that's easily 2 years worth of premiums on that, or close to it. And then the same thing right here for 4P is the non-invasive physicians. And you can see the rates are even lower there. And that's mainly just goes by claims. You know, like anesthesiologists have higher claims than emergency medicine. Emergency medicine has higher claims than internists, et cetera, on that. So that kind of gives you an idea on the rates on that. And then the last.
Could I add in one thing quick, just
Sure.
in case anyone's not reading the chat? DK Unger replied to this. It was a question about kind of your maximum benefits. So if you sign up as a resident for the standard insurance plan we've been talking about with the insurance company called Standard, then you're starting out at that 5,000 benefits, say, you can increase up to $10,000 total later on. So the maximum benefit you get with this specific policy would be $15,000 a month. And if you wanted to go above that, you'd be purchasing some supplemental policy.
Correct. You'd have to answer medical questions, but yeah, everybody that leaves UCSD can secure $15,000 a month of coverage. For the females, it's going to be gender neutral for their entire career, which is huge. And males, they get a discounted 15% or $15,000 a month with no medical questions. So it's pretty much, you know, policy that you could take with you and never put it in a drawer and not have to think about it, hopefully ever again. Because the only times you're going to think about it is something like now or when you get disabled. And insurance is the one thing you can't buy. It's not like you're hungry, I think I'm going to go get some food. It's you have to do it, you know, just like you have to say like, okay, I'm going to be hungry tonight. I better go to the market 2 days ago, so that when I get home, I have some food in my refrigerator, that type of thing. So it's something that you should have. I mean, insurance, everybody believes in insurance. You all have, I'm sure you all paid your parking meter to ensure you didn't get a ticket. You guys all tried to study hard to get good grades at school so you get into medical school. You know, you show up for work every day to ensure that you're not going to get fired. So this is just one thing that you're going, okay, hey, if this is the only type of insurance that's going to pay you. Every other type of insurance you have pays somebody else. But this is the only type of insurance that pays you. Whether you have, I'm sure you all have insurance on your car, your phones, you know, who knows, maybe your jewelry, whatever it is. But the one component that kind of the goose that lays the golden eggs, so to speak, is you guys, and you want to make sure that you're taken care of on that. So with that, I'm going to thank you all for your time. And if there's any questions, we could answer them now, or if you have you want to email us, you could do that. Our contact info is at the beginning of the. I think, did everybody get a packet, Shane? Or
yeah, so I sent the packet through the chat. I will also be making it available to everyone via the Dropbox, which I've been using to upload recordings as well as some other materials. So Andy, thank you so much, and DK, thank you as well for being here and educating us on this. I had a couple questions that I would love to start out our Q&A with.
Okay.
And so I'll hit a couple things I'd like you to talk about even briefly, and then one question related to the disability insurance. So could you, after we finish up disability, just briefly touch on the difference between term life insurance and whole life insurance, or cash value life insurance, goes by many names. And then, but before that, I have a question about kind of getting the standard guaranteed policy. So if we are moving out of state after residency, and kind of knowing that California has the highest disability insurance rates, are we able to secure a lower rate based on the state we will be practicing in, or are we kind of married to these California rates?
That's a great question, Shane. But what we've been able to negotiate with Standard is if you give us your address of where you're going, we can use that state's rates. So if you're here and you're moving to Montana, you give us a Montana rates or Montana address, and we can use Montana policy in the Montana or whatever state it is on that. And we've also for those instances, we've extended so you can have your policy go into effect as late as September 1st, as long as you kind of sign up before you leave. So as long as you sign up, say during June, we could have the effective date of the policy as late as July 1. I mean, as late as September 1, or 60 days after you complete your training, because some fellows complete 8/1. And so that means that pushes it to 10/1. Or if someone's on a, and I don't know if we have anybody this year in anesthesia, but sometimes we have people that are kind of off cycle, or they may finish November or something. So it's 60 days from whenever they complete their training is the latest date we can do that. But yeah, we can date or we can use whatever state that you want on that.
Okay, but the key is we have to submit that application before we actually.
Correct.
Okay.
Yeah.
And
And
then
then
kind of
go ahead.
a related question to that. So if you secure a policy and you're practicing for say 10 years, but then move to another state, can you get a rate adjustment based on your new state?
Not on the existing policy,
Okay.
but anything new you could.
Okay.
So what you would have the option, say, like if say you had a Montana rate and then you move back to California and you increase your coverage, well, then you could use your rates would always be Montana rates.
Okay.
Or if you're in California and you moved to Montana after you established the policy here, say you practiced here for a few years, then you move to Montana, then that increase could be used. You could use Montana rates for that.
Okay.
So, and Standard, by the way, is the one of the few companies that does that. That's one of the differences with Mass Mutual. You're kind of stuck with the rate where you started. So if you're in California and you move to Montana and you want to increase your coverage using your future insurance option, then it's still going to be California rates. So they don't give you the new state's rates on that. So that's a difference on that. So you want me to kind of review the differences between life and different types of life insurance real quickly, or?
Yeah, I don't see any other questions in the chat about that. So if you don't mind just taking a few minutes to do that.
Sure. Okay, there's basically two types of life insurance. There's term life insurance and there's whole life insurance. The term life insurance is just like it sounds. It insures you for a period of time, or a period of time. And it's just pure insurance. There's no cash accumulation, etc. And you could, if you die within a certain period of years, like 10 years, 15 years, 20 years, or whatever, what the insurance company does is they give you a rate based on you keeping the policy for 10 years. The rates will stay low for 10 years. And then in year 11, you have the option to continue the policy, or you can cancel the policy. If you continue the policy and you've had a health change, then you may be subject to paying higher rates, because now in year 11, the insurance companies, they know, well, the only reason why you're going to keep this policy is because you have some sort of health issue. So they rate their plans accordingly. And that was kind of the first type of insurance, was term insurance, because that's all people said. But a lot of people just go, well, hey, you know what? We don't like this increasing premium as we get older, because it's good for the insurance companies, and they cancel us right when we need them. So some of the companies then, what they did is they said, well, how about if we design a plan that has a level rate for your whole life? And hence the name whole life. And so in order to do that, they had to level a rate off. And so what they do is they overcharge you in the beginning so they can undercharge you at the end. And so they calculated it out so that they overcharge you enough so that their investments, et cetera, will keep them, so they can, you could pay the rates, they'll keep them in force, and they'll have enough revenue to pay the claims on that. But in doing that, what happens is they build up a lot of cash in the beginning, and then they kind of start using that cash to pay the premiums to keep them level throughout the length of the policy. Well, then the next step on that is like, well, look, the insurance company has all this cash. We're not doing anything with it. Maybe I want to let people have access to that cash. We can't just give it to them because that's going to affect our calculations. So let them loan we'll loan the money to them. And so they started loaning out the cash values on that. And it went for a long time, but notoriously the insurance companies, back when that started, they didn't really give a very high return, and they were charging a high interest rate, like 8% for that. And so, but that still went along for about 40, 50 years until now there's kind of hybrid policies that are universal life policies that you can design like a term policy. But I would say, I make a general statement that probably everybody should have term insurance. And until you get to the point to where you're fully funding your retirement plans, you've bought your house, and you're prepaying your mortgage, etc. Until you get to that point, then after all that, then you might want to start looking at a whole life type policy, not whole life per se, but what we call a cash accumulation policy, where you can design the policy to accumulate cash somewhat similar to a Roth IRA, which is you can't deduct the money that goes in, but the money that is in there, it accumulates tax deferred basically, or tax free, and then the money you get out is not taxable. So there are some places for that. A lot of times businesses will have it. Sometimes it's used for like for deferred compensation plans for businesses, etc., where they're going to say, okay, if you die, we're going to pay your family X amount of dollars so that they'll be okay. If you live, we're gonna pay your salary for a certain number of years. So there's places for every type of policy, but for right now, for what we see for most physicians, I would say term insurance is probably the way to go. And unless you say, Andy, I just can't save any money any other way. I blow it. I know I work hard, but I spend everything I make. Well, then that's a whole nother subject. But we haven't seen too many people like that have that. But it does happen. So hopefully I answered your question as far as what you should have. And in every situation is unique, though. If there's someone, if you want to do something special, one thing about insurance plans they are unique financial instruments, and an experienced agent can design it to be pretty profitable if it's set up properly. The unfortunate thing is it's not, and it's if you don't really know how the policies work, you can get burned pretty bad on that because of the interest rates and because of the mortality costs that are built into the policy. A good rule of thumb on that is, if you're looking at a cash accumulation policy, is if you look and someone presents you something and the death benefit is an odd number, like $783,000 or something like that, that means that policy is designed to maximize cash. But if you say, hey, I want to deposit $10,000 a year, and they come back with a policy, it's an even $1 million or something, then you're giving up some value for death benefit, which you don't want to do. on that. So, but we can even have another session on that if you want.
Yeah, no. I think you did an excellent explanation. And I think, my belief as well is that for the vast majority of people, including physicians, term life is really the way to go. And,
Correct.
To dive into whole life policies, you should really already be maxing out all of your other retirement savings vehicles.
Correct.
And if anyone was here for the last session, we learned about the variety of policies for retirement savings that UCSD has. I did get one more private question, Andy. I hope you're okay to stay for maybe one more.
We'll stay as long as you guys want.
Awesome. Is there any benefit to having multiple disability policies versus maximizing your benefit on a single plan?
Not really. I mean, because the insurance companies are all kind of reinsured for the benefits. And if anything, at claim time, believe me, we DK and I help people with claims, and there's a lot of paperwork. And if you have 3 policies, that means at claim time, you're going to have to file 3 different claims. Go to the doctor. Your attending physician is going to have to file 3 different forms. The terminology in each policy is different, and so if you can get one good policy, that should suffice. And there's also insurance companies have something called participation limits. So based on your income, there's a maximum amount that you can qualify for anyway. So it doesn't matter. In other words, they're not going to allow you to say if their limit is $15,000 a month, as an example. Well, you can't get $15,000 a month with Standard, and then another $15,000 a month with Mass Mutual, then another 15 with Guardian. You're only going to be able to get 5,000 with each, say, on that. So there's really not, there's no advantage to doing it at all, really, on that. And you're going to be paying, there's a policy fee with each policy. So, you got 3 different bills you got to pay. It's the terminology is going to be different, so it's not an advantage. So I would discourage that.
Okay, excellent. And then one of our participants noted some exclusion criteria related to pregnancy, but there wasn't a ton of detail. Could you just expand on if pregnancy is excluded in disability policies?
Yeah. In all individual policies, normal pregnancy is excluded, but complications are covered.
And so what does that mean? Does that mean, you can't say I'm pregnant, so I'm disabled, but if you have any
Well, there's a 90-day waiting period. So in other words, no matter what, if you deliver a baby, you're not going to be out for 90. Normal delivery, normal pregnancy is not going to disable you for 90 days. So all the policies have a 90-day waiting period. Now, if you have complications where they say you need bed rest or you have a C-section or something like that, then you are covered for that. But normal pregnancy is not covered with any of the policies.
Now, if someone has had a C-section, they wait till, say, after they've finished training, apply to Mass Mutual for a policy, because they've had a C-section before, can Mass Mutual say, we're not even going to cover pregnancy complications for you? It'll be excluded?
Correct. It's basically 100% chance that that's going to happen. If you have disability companies, that's what their knee-jerk reaction is, to exclude something, because they're not going to cover something that you've already had. That's another reason why the standard plan is so valuable. Anything like that, and it may seem something minor, but they are not going to cover. If you've had a C-section, you're not going to even get covered for any future normal pregnancies or any future complications. If you've had a bad knee or something like that, you're not going to be covered for that. So if you're a rock climber, you're not going to be covered for that. If you start doing these things after the fact, after you get the policy, or if you get the UCSD policy, that's not going to be a problem. But any time when they're going to start asking you questions, you're not going to qualify. And that even goes with the AMA, because they ask you questions as well. So So there's the only way you might not have any questions is like if, say, if you join UCSD and you sign up for the plan within the first 6 months or something. But even then, any pre-existing condition is not going to be covered for 1 or 2 years. So, but that's an excellent point, man. Yeah, anything that you have or thinking about having, and is if you apply and they give you an exclusion or something, that there's no reason to accept that. And that's what we try to do, is we try to let everybody know that, so that doesn't happen, because there's no reason for that to happen. When you have an opportunity like this, there's no reason to accept something like that. But
As,
go ahead.
oh, go ahead.
No, I was just going to say, so that's a good point that you brought up, Dan.
As a follow-up to all this, is with insurance in particular, like with everything, honesty is generally the best policy. With insurance, brutal honesty is the best policy, because if they find you to have been dishonest about even the most minor thing when you got your policy, they can disqualify you for any kind of benefits.
Correct.
They may go searching. If they're going to have a big payout for you, they may go back and search. They'll probably talk to every other insurance company, see if you've ever filed with them, see if they turned you down for anything. They'll look into your health records. So be brutally honest when you fill out these forms. You may pay a little bit of a higher rate, but you know you're actually getting the insurance.
Yeah. Yeah, because you don't want to have after the fact them go, oh, and what they'll do is they'll find things in your medical report where you were referred to another physician, whether you went there or not. They do a script check. So, I mean, we've had cases, before where, and I don't know if you could believe sometimes, but they say, oh yeah, I prescribed that for my mother. I didn't take it. Well, or there's something in your script check that says, oh yeah, you were prescribed XYZ or whatever. And they say, well, but I never took that. I said, well, they don't know. All they know is you bought it, you prescribed it. And so it's the same thing. Insurance companies are very good at assessing risk. And they know where to look, and they do their due diligence, because they know, particularly these good companies, they know that once you get a policy, their contractual provisions are such that where if you have a claim, you're going to get paid. And that's why it takes, other than with the UCSD plan, it takes a couple months to process a policy. It's not an easy process. They look for things on that. And like I say, they'll find things that most of the time, a lot of times people say, well, I didn't even know. I didn't even remember that, and a lot of times it's true, but it doesn't matter. The insurance company doesn't go by that. It's like, if you didn't put it in there, and that's what opens up that 2-year incontestable clause. And it could even go longer if they find that it was a fraudulent misstatement. If it looks like, oh, you intentionally didn't disclose that. So, but that's an excellent point, Dan, to just make sure that like I said, we've mitigated that, because you don't have to do that with our plan. But if you feel free to try other companies, but know that you're gonna be under scrutiny on that, and sometimes it's worth it. I mean, looking at the numbers and everything, I don't know if it is in these instances, but if you were at an institution that didn't have a pre-approved plan, then yeah, you're pretty well twisting in the wind out there, hoping that you get coverage on that. So
yeah, and just a quick note, I would also recommend, before you apply, take a look at your medical records. I did for mine, and my PCP added a 0 to my number of alcoholic beverages per week. So I was initially listed as drinking 60 drinks a week.
Yeah,
would be impressive.
Yeah,
that was pre-COVID.
Yeah, and that's the truth too. I mean, you guys obviously are physicians, but it's astonishing how often medical records are inaccurate, and it's like the old adage, proving a negative is difficult. It's very difficult, and I mean, we've had instances where someone goes in for just a routine medical exam with an internist, say, or a family practitioner or whatever, and they ask, well, how's your day going? You know, it was bad today. I'm just getting tired of this job or whatever. Next thing you know, in the chart, it says they're depressed. And so now the insurance company goes, well, did they ever get treated for their depression? And you go, what do you mean depression? I never been treated for depression. But the insurance company looks at it and they look at numbers. What they look at is that, and it's different than clinical medicine. And this is one thing that you guys also need to remember is you may say, oh, you know what? I know I blew my knee out in the, and I use an analogy a lot of times like NFL draft picks. Before you blew your knee out, you were a #1 pick. You were the best running back there ever was. Now you blow your knee out, you're still pretty good, but now, you know what? NFL teams are not going to maybe draft you #1 overall. Maybe they're going to draft you number 3rd or 4th. So they're going to and that's what the insurance companies do. If you're healthy, you're a #1 draft pick. When soon as things start nicking up, then you start dropping. And if you drop enough, they might not even give you a policy at all. And because they go by, if they draft 10 running backs that have bad knees, well, they don't know which one is going to have a problem in a game in the future, but they know that one of them is going to have it. And so they're going to say, you know what, we're just not going to draft anybody with bad knees anymore because it's not worth it on that. And that's what the insurance companies do. They say, well, you know, if you have a heart palpitation, they might say, you know, we don't know. We know that everybody that has other health issues, it all starts with a heart palpitation. But you know what? We don't know who it's going to be. So it's not worth it for us to get 10 or 20 or 50 or 100 people if we know that 2 or 3 of them are going to be bad and they're going to cost us. Because even you can look at those numbers, 200 a month to get 5,000 a month of coverage to age 67. Well, you don't have to be wrong too many times to where it starts adding up, because that's $60,000 every year when you're only getting 2,000. You know, so if they mess up a couple times, you know, that underwriter's out of a job and the company is hurting, because then they're going to have to start increasing their rates, which means they're going to get less business, and so it starts down that road. So they you know, because they can't make that up, because to change the rates, it takes about 4 or 5 years. So if they mess up when they're issuing a policy and give someone a policy that is a bad risk, it bites them pretty quickly and pretty substantially, because you could look at, you know, you look at it in $1 million, you know, 60 grand a year for 10 years, that's 600 grand right there. You know, and then in 20 years, you're looking at, that's a big risk. And that's one thing people don't understand. And DK and I, we get this a lot. So, well, I'm healthy. There's nothing wrong with me. And the very item that they want to have covered, and they're saying they're so adamant that they want it covered, but insurance company doesn't want to cover it, but it's important for you to have it covered. So we're going, why, if nothing's going to happen, why do you want that covered? So yeah, that's one of the things that we do. And I have to say that we're good at getting you an honest offer from an insurance company. It's not always going to be covered, but we'll make sure that everything in your medical record is analyzed. You know, everything that you have, and this is mainly more for life insurance for you guys at UCSD, but just to make sure that everything is analyzed, go to the right companies that are going to be sympathetic to whatever situation you have. And, you know, and again, coming back to let the specialists specialize in what they do. And you guys specialize in anesthesia, we specialize in disability and life insurance. And part of that specialization is underwriting. Luckily, we don't have to do it with the UCSD plan, but with life insurance, we do it all the time. Other disability plans, we do it all the time. I said we probably spend more time doing that than anything else on that. So, no, it's just like anything. It's a lot. So it looks like a lot easier on the outside than the inside. It's the old, like a duck, the duck is floating around the water, but those little legs underneath the water are going like crazy to keep it going. So that's kind of like us, just like you guys. People might look at you, oh, look at this and that, but it's not that way. So, but thanks for your time. And any other questions, Shane? Anything else that wants to
I
cover?
think I might have one last one.
Okay, sure.
So if you're paying for your disability insurance after taxes, you've paid taxes on the money you paid with, then when you get your benefit back, are you being taxed on the benefit you're getting paid back?
No, the benefits are tax-free. In other words, if you did not deduct the premiums, then the benefits are not taxable. But if you're a corporation and the corporation pays for the policy and you deduct it, then the benefits are going to be taxed as income. Now, one caveat on that is where the government works it is they base it on the year that you're disabled and how you paid for the premiums that year. So say you're incorporated and your corporation pays for the policy in 2021, say. But then towards the end of 2021, you get COVID and you say, oh, I'm going to be disabled for 6 months or something. Well, then 2022 starts, you start paying for it personally. And that will qualify. You can't do that with an accident, but for sicknesses, you can kind of manipulate around a little bit on that. And you could change, you could deduct it or not deduct it. So
I think that might be our last question. You have anything else, Shane?
I am tapped out.
well, that's good. That's good. So
All
so
right.
hopefully everybody
Well,
gained some information and gained some knowledge, and it'll help you in your search for adequate comprehensive disability coverage, because it is important, and I recommend every physician to have some.
All right. And again, everyone, I'll be sending out Andy's contact information. It's also available in the packet. I put a link to the Dropbox folder with information and recordings from all the prior sessions. So that packet's in there as well. So thanks, Andy. Thanks, DK. Thank you, Dr. Lee. And thanks to everybody else who joined us tonight. Hope everybody has a great night.
Thank you, everybody.
Thank you, everybody. Thanks for putting us on, Shane, Doctor. Thank you. We appreciate it. And we're here to answer any other questions when you need us. Thanks a lot.
All right. Take care.
You too. Bye-bye.